Hello and welcome to the RAS Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Andrew Page, welcome back to the Australian Investors Podcast.
Good to be here, mate. Good to chat. How are you?
I'm very good, man. I'm very good. It's always a pleasure to chat with you. And you're joining us from your new establishment, which listeners of the podcast that you and Scott do or just follow along with Strawman would know all about, I'm sure. But mate, it's good to chat.
I'm on the property ladder, apparently.
You are. Welcome to the Ponzi, mate. Welcome to the Ponzi.
You know, if you can't beat them, Owen, you got to join them, right? So one thing I will say to all your listeners is that if ever you wanted a very clear and obvious sign of the top, they say no one rings a bell at the top or the bottom. I'm ringing the bell, right? The fact that I've put my leg or I've dipped my toe in the water, this is 100% the top of the market. Look out below.
Now, correct me if I'm wrong, but you did own a property previously. Is that correct?
Yeah, about 10, 11 years ago, we bought. So this is what we did, right? So because I'm just an idiot. So we bought a really modest house and it's fibro, 2-bedroom, like before we had kids, we had a kid while we were there, but really cheap. Like I'll tell you how much. It was $330,000 out in the west of Sydney, right? Like I know, right? And the bank at the time was going to lend us much, much, much more. And I thought, I don't like debt. Debt's bad. I want something small and modest. I'll pay it off really quickly, and then we'll upscale from there. And actually, everything went really well to plan. So we paid it all off. And then it was like, actually, let's sell that. We'll move a bit closer. We used to live in the inner west of Sydney. So let's go back there. We liked it there. But let's just rent because we don't want to rush. We'll just make sure we find an area that we like. And, I remember saying to my wife, it's not like it's going to double in the next few years, right? Like, what? And of course, it just that was the time when things really started to explode, particularly in Sydney. And it just sort of like flew away from us. And it's kind of like, it was obviously in a lot of ways a regret, but it was that the other dumb thing I did was I thought, wait a second, I'm a professional investor. I've got all my capital tied up in bricks and mortar. Bricks and mortar is not very productive. Maybe I'll get 5, 6, 7% per year. That's sort of what the historical average sort of might suggest. I'm getting better returns in the market. Let's take the capital and invest it in the market. And I did. And it went really well. But I should have just sat there. What I didn't factor in was leverage makes a difference. Now everyone knows that everyone should know leverage is a double-edged sword. But when things are booming, like leverage is definitely your friend. So there is that. And the other thing that I didn't put into my spreadsheet, I'm sorry because I'm sure a lot of people have heard this story before, is that I just thought we would rent and that as long as we were paying the rent, we'd be fine. What I didn't factor in is that every idiot in Sydney who owns a property has got zero interest in the income stream and just wants to flip it every 12 months. So we got kicked out every 12 months. So it was sort of like when you factor in the moving costs and the stress and everything else, it was like, I've made a terrible mistake. But we have rectified that now, and we're loaded up with debt, and we're back in the market. We're doing the Australian thing.
People who haven't played along may not know that Andrew was profiled on, I can't remember, it was ABC or something.
7:30 report, yeah.
7:30 report. He was the pin-up boy. So, mate, it's funny how we've come full circle. And you know what? That's the crazy thing is like, on our property podcast, Pete Wargent, who I know always says that like residential property in particular is like this sacred assets. One of the sole reasons for that is it can be leveraged and the debt is cheap. And that's
no capital gains on the primary residence.
Yeah.
It's funny. Like, so I forget who it was now. The ASA might have been set up a property debate, bulls versus bear. Because I'm sort of notoriously bearish on property, and go figure. And the funny thing is after the debate, it was like we were just in like unanimous agreement. There was actually very little difference in devil's in the detail, right? And there's a hell of a lot of nuance that was sort of there. And it's like, we're not a mile apart here. We actually had him on Strawman afterwards to talk about it in more detail. So I get a lot of time for Pete.
Yeah, he's great. It's just an undeniable thing, right? It's just the Australian dream keeps rolling on. And but it wouldn't be, I was just thinking as you were saying that no capital gains, wouldn't it be nice if you could just pick one stock in your portfolio and the HCO just let you pick that stock and you're like, that's the one that's capital gains free. Thank you very much.
Yep.
I wonder how people, there would be no tax revenue collected amongst investors, let's be honest.
Although it sounds like, you know what I would do, given my luck, I would go, I want this one to be capital gains free. And it'd be the one that tanks. And the one that did really well would be the one I'm paying tax on.
Today we're going to talk about 5 companies of varying shapes and sizes, starting from one of the biggest right down. We've got CBA, Seek, Pro Medicus, we've got XRF Scientific, and we've got Catapult. Many people in the Strawman community are really familiar with Catapult and XRF. I think you were the first person to bring XRF to my attention many moons ago, and I just checked it before, and it's $1.41 for anyone that's playing along at home. It's wonderful. Number 4th on the Strawman community ranking. So
at the moment,
widely, yeah, we'll go with that. Widely followed. But before we get to that, I've got a question, which is how you prepare for reporting season, because we're in the thick of it right now. But before I get to that one, Strawman is now open. When Strawman is Australia's premier investment club, and it is by far, I'm going to talk it up because I know you're too modest, but it's the best investment community in Australia by far. And really, really interesting insights for folks who want small to medium Australian companies, also large companies, but mainly those first 2 categories. Absolutely wonderful insights and scuttlebutts, and people can have to contribute to the community to be part of it, which is just totally wonderful. I'm curious, why do you only open it up for select times of the year?
Because I'm lazy is the best answer for that.
That's good.
I mean, as you know, so you and I are both, we're suckers for punishment, right? So we thought, what industry should we get involved in? I know, let's go with something that is highly cyclical, that has incredible amounts of churn, and the biggest regulatory burden that you can possibly find. Yeah, let's start a business in that area. So, and the tricky thing is that, and this is true for guys, and for whatever reason, this is a male-dominated industry, and like anyone who runs a business here, you'll find it's 70, 80, 90% male, which is really ironic given that all the research suggests that the girls are the far better investors. But and you know what? That's a whole topic on its own. I reckon it's because what the guys have is arrogance. Because every dude out there is like, I can be Warren Buffett. I'm smart. I can do that. And so every dude at some point in time goes, I want to get involved in the stock market. And there's 2 outcomes, right? You don't do very well, in which case, screw that. I'm not doing that anymore. Or you do okay, but you realize and recognize that, oh my gosh, that's very much scarier than I thought. And it's a lot more work than I thought. And the end result is that you just see a huge amount of churn. So you're always selling. And for me, it was sort of like, I wanted to focus our time, my time at least, on running the club, looking at stocks, not selling. And so if you come to our site 9 times out of 10, it'll be, we're not open. Join our wait list, and we usually open once or twice a year. And if you're interested, come and do it. And if not, that's fine as well. And it just means that we can focus where we need to focus, and it takes the pressure off.
Yeah, I know you have limits on the amount of people that you let in, because it is a lot of really unique, like small caps, mid cap type companies, and frankly, that you don't want to have a lot of members, because if you have too many members, then a lot of the research, gets out, or, you want people to be able to get the maximum benefit from it. But I do have a lot of...
It's also, just very quickly on that, the trouble is that when you are a small cap investor, and we've actually just this week, we spoke to a company with a market cap of 20 million. It might have 1 or 2 days where 0 trades go through, and other days where it's like, you might be lucky $20,000 worth of trades, crosses on the market. And you can crowd out that thing, and you can basically, there are massive liquidity issues. So we like to keep it tight, because there's a reason why fund managers don't invest in a lot of these companies. It's not, I mean, a lot of them are rubbish, but a lot of them are great. But they can't, because if you're a fund manager with $100 million, it's just like, there's literally not enough volume on offer for you to fill a position. So you just don't touch it, which means it's wide open for people like us. But you just, there's not room. There's not a lot of space there. So you got to, you've got to try and restrict it. I think the other thing is as well, I came to the conclusion that I want quality over quantity. And that sounds really elitist, but I want, here's the value prop for you, Owen. Join Strawman. It's not cheap. It's $1,000 a year. We're not going to give you any research. Actually, we would like you to share your research. And it's called Strawman because you're probably going to find that whatever you put out there is going to be good faith and respectfully and all constructively, but it's going to be challenged, because the best way to improve an investment idea is to challenge it. And it's like, that is a hard sell, right? There's very few people who go actually connecting with a network of engaged investors where it's all merit based on ranked. I don't want to be told what to do. I just want a set of ideas and I'll take it from there. That's the minority, right? And I recognize it. So we're always going to be a niche thing. We're always going to be small, but we're going to have really high quality members who hang around and continue to sort of cooperate and constructively, turn over lots of rocks and make mistakes together and find some winners together. And it's just keeping it tight it's not for everyone, but for me, it's proven to be the formula I like.
Yeah, and the index kind of speaks for itself, which is that even though it's been very challenging for some small cap investors the last couple of years, the index is still doing very well. So, here's the thing, right? On the end, it is, since we started Strawman, we've absolutely smashed the market. When we went to the premium model, was literally within a week of the absolute top of the small cap market. So it was just like, are you kidding me? So it depends on, like all indices, it depends on where you want to measure it. So I have to put that out there, because it hasn't been good since August of 2021, which is the top of the market. In the last 3 months, it's been perfectly decent. I expect it to be fine. But I would also say too, no one in our community blindly follows that thing. It's more to sort of say, hey, what are the most popular stocks held across the index? But yeah, that's what it is. Yeah, cool. I was going to say before, I get a lot of people come up to me at the Rask events, and when I mention Strawman, because they're interested in companies and small companies, medium-sized companies, whatever. They're always like, yeah, I'm on the wait list, or like I've got the free version. So that's why I was super keen to do this episode today, because you and I had a phone call earlier this week, and you told me that it was open. So for folks that want to hear more from Andrew, get amongst the community, these types of things, there will be a link in your show notes, and it closes Monday. So just hurry up and get over there.
Yeah.
But mate, I wanted to ask you, before we get into the companies, how do you prepare for reporting season? Obviously, you're looking at heaps of different companies. You've obviously got the community there. How do you personally actually prepare?
I think that what you want to do is you don't want to put yourself in a situation where you're going to be reacting to things from a position of not being prepared. Too often what we do is we go, such and such has released their announcements and the share price is up. Oh, it must be good, or it must be better than expected, and vice versa. And it's like, I think that's a really bad framing, and it's a really bad sort of, the market is there to serve. It's not there to inform, right? So what I like to do is I like to have, before I buy anything, I've got an investment thesis. I've got this is why I like this business. This is what I think the businesses are capable of doing. And this is what I think is a reasonable value based on all of that. So it's sort of simple but not easy kind of thing, but that's kind of what I'm looking for. So if I bought a company where I felt as though this is something that's capable of sort of double-digit earnings growth over the next few years, I want to see a result that's going to justify my initial expectation. Now, I think a saying that I'm very fond of lately, I only heard it the other day, which is never trust a forecast with a decimal place, which I love.
Oh, that's
because
great.
The future is too uncertain, right? So I would be lying to you if I said, well, actually, in anticipation of the earnings season, I'm going to do what every other idiot analyst out there does and have like 8 decimal places behind my EPS forecast. I'm not that smart. No one's that smart, right? It's impossible to do. But I do know that if I was sort of expecting a business to sort of grow, let's say mid-single digit rates, and it comes in at 4, 5, 6, I mean, what's the difference? Like the market's probably on the day, oh my gosh, profit grew at 5%, but forecast was for 6.5%, and the thing will be down 15%. I'm like, I don't think anyone who's run a business going, yeah, that's about right. You know what I mean? Like that's kind of in the ballpark, right? So I like to think of what is a reasonable result before I see the number. And then when I see the number, because it's been released, like, well, how does that compare with what I was sort of hoping for? And is it broadly in line with that? I'm not going to worry too much about the specifics. I'm going to try and look more beyond that and sort of say, look, has the company's competitive position strengthened or weakened since I last looked at it? Regardless of what the earnings have done, is the glide path, we still on track there? Is this business still likely to end up where I feel it's likely to end up? And I actually think gives you wonderful opportunity there, because while the market will throw the toys out of the cot because, it was a 3% miss on consensus guidance, for me, it's kind of like, there is nothing wrong with this story, and now I've got the opportunity to buy this thing 10% cheaper. Or vice versa. Like, it was kind of okay. I guess it was better than what the market had expected, but it wasn't as good as what I was expecting. And now shares are 10% more expensive. I mean, if anything, I'm not a trader, but if anything, now I'm less enthusiastic, right? So what I'm trying to say is, Peter Lynch famously said, know what you own and why you own it, right? And I think that if I was ever to get a tattoo, that'd be up there as a main contender, right? Right across the chest, maybe the forehead even. And if I've got a good sense of what I own and the reason as to why I own it, when I see the numbers come out, that's going to help either convince me of justify the conviction, or it's going to undermine the conviction, and that's really what I'm looking for.
Yeah,
and it's a very imprecise, fuzzy wuzzy kind of way of looking at things. But I think if there's one thing that plagues our industry more than anything, well, there's a lot of things, but it is false precision, and false precision. You're in the wrong game if you're after false precision, right?
Yeah.
But if you, I'll put it this way: it's far better to be generally right than specifically wrong. Yeah,
agreed. Well said. I know you've carried that perspective for a long time.
Yeah, served me really well.
Yeah,
you know what I mean.
Yeah. I think that's the key thing: is you're anticipating results. There are fewer surprises, and you can just sleep easier at night. Yeah. I think that's the difference. I speak to a lot of people, as I'm sure you do, that run their own business, and they will be the first to tell you that, what are you guys talking about? Like, who cares if the profit margin was this? Have you ever run one of these things?
Yeah.
And that's what I find is there's something like really elegant in the simplicity. It's like sometimes it's like easy to kind of knock people that are like, yeah, I bought it for this general reason and I'm pretty happy with that. Because then the super smart analyst brain kicks in and you're like, yeah, but have you checked this return on invested capital over the last 2 quarters? Like, what? Oh my God. That stuff I don't think carries as much weight. It's more transient. So I really like that, mate. And I really like your perspective on all these things.
Just quickly on that, I think there's a great doco, The Smartest Guys in the Room, which is about the Enron collapse, whatever. And it's a weird irony that often the smarter, and I mean like IQ sort of smart people here, will often be the most dangerous because they're so convinced of their own genius that they lack any humility and they get overly precise and they build these incredibly complex spreadsheets and everything, and they lose sight of the forest for the trees. Actually, I saw a really great Morgan Housel tweet the other day. He's an incredible writer. And he said, be grateful that you lack the intelligence and sophistication needed to blow yourself up in a leveraged yen carry trade during a bull market, which I thought was just chef kiss, right? Like, it is the more sophisticated the strategy and the more advanced your modeling, the more you need to slap yourself in the face and say, you are mortal, right? Like that is, as opposed to the person who goes, you know what, this is a really good company, really strong competitive advantages, price feels about fair. I'm just going to buy that and chuck that in the bottom drawer for a few years. That person will generally do far better than the person who has a 400-page thesis and a 10 megabyte spreadsheet. It's the KISS principle. Keep it simple, stupid. Buffett has been banging on about this for more than 50 years. And when I think it's this famous interview, it might have been Munger, and they said, well, you guys are so successful. How come no one copies you? And the answer was, because it's too easy. Like it just seems it's too simplistic to sound like it would work.
Yeah,
we're just buying good businesses at good prices, and that is not nearly as appealing a message as someone who says we're actually looking to rotate out of this sector, which is coming in through some more tailwinds behind this structural shift in the economy versus a change in interest rates, and let's not and it's just a word salad of jargon, and it just belies their complete ignorance in the complexity of the world in which we live in. So yeah, don't lean into the simplicity is what I'm saying.
I love it. I love it. I love it. You're preaching to the choir, my friend. Yeah. And I mean that's the thing I try and emphasize as much as I can when I speak to people is you don't need to know everything about everything, or if you do, that's fine, but that's not what's going to see your thesis through. Like one of the companies, why don't we just actually jump into one of these companies, which we'll do it in a different order. When we start with Pro Medicus, I've got a general question about this in a minute, but Pro Medicus came out with results. Is it a surprise? Maybe it is to some people. Profit, revenue up 29%, profit up 36%. Margins, EBIT margins we're talking about here, 69.5%.
Oh my gosh.
Which I remember when Sam, the CEO, was like, and Clayton, the CFO, I think they were about 55%, and they were like, listen, don't expect them to be this high for much longer. Yeah. And now they've gone towards 70, 155 mil of cash in the bank. That's up 28%, no debt. A dividend of 22 cents, with from memory, it makes it the full year dividend of 40 cents, which is a 33% increase in the dividend. So obviously unbelievable. Let's tie this back to this idea about having a thesis that's really simple in an elegant. If you were trying to analyze every single half year result, and by the way, I'll put a link in the show notes to Claude's write-up, because Claude, a mutual friend, done that most absolutely amazing write-up on this. Yep. He does analyze it half year, and he talks about all like the the sociological factors that go into trying to predict what Pro Medicus will do next. But if you had one of those really complicated models, and I had one of those for a very long time, Andrew, full disclosure, it could have just thrown you way off. Like I remember selling half of my Pro Medicus shares at $13. And what is it now? It's $148.
Don't look.
I'm still grateful that I own some. Like, let's
I bought it at 85 cents back in the day, right?
That's what I was going to ask you. Were you the first of all of us? I think you were.
I think I was, but it was
85 cents.
Yeah, and can I tell you, I bought a lot. I mean, for me, I bought a lot. But before anyone mistakes me for a genius, I did the too smart thing, which was, the value proposition isn't as good at a higher price. So I was sold down, and plus I need to reweight the portfolio. It's like I should have just idiot. If I had not sold anything, I'm not speaking to you right now, dude. I'm on my yacht somewhere, right? But I can't complain. I did extraordinarily well out of it. I finally got rid of my last holding. That's why the share prices continued to pump up, obviously afterwards. But I tell you this though, had you asked me then, Andrew, what do you think is likely to happen with this company? There is no way on God's green earth I would have said it is capable or likely to do what it eventually did. Like it took me by surprise as much as anyone. And that's why I was selling down on the way up. It was just like, well, it's a good company, but gosh, it's pretty expensive. And if you ask me right now, would you buy any? I say no, it's too expensive. I said that at 100. I said that at 80. I said that at 60. But it is clearly one of the best companies on the ASX, one of the best companies to ever grace the boards. To put this in context, a world-leading company with incredibly entrenched, dominant market position, you might think 20, 30% is pretty good margin, And what did you say they were? What's their EBIT margin?
69%.
60. Okay, so maybe on a net margin basis, that's still going to be like 35, something like that. That is insane. And here's the other thing that these guys have done, which is just, this is a masterclass in capital management. Often when you see, like, pick any high-flying stock that you want, on the way up, they have raised money, not in a necessarily a bad way or proved to be a bad decision, but there was dilution that happened on the way, or you just needed to bring in outside capital to juice the growth, to fund the expansion. This thing has been entirely internally funded.
Yeah.
From its, while paying dividends.
Yeah.
And growing like that. It is. And then what did you say at the start? So the revenue is up in some insane amount, and then the earnings even more. So it's also showing you operating leverage because the costs aren't growing as much as the revenue. So you get this leveraged gain in profit, and they do that. They run on the smell of an oily rag. They've got incredibly resilient revenues. They're in an area where they just here's another thing to look for. Look for companies that are positioned well for a structural shift within an industry. The classic example here would be the car sales of the REA groups of this world. It was classified businesses on the newspaper, and they all went online. And surprise, surprise, they've been incredible investments. We might talk about an exception to that in a moment, actually.
In a minute,
yeah. Well, more recently, an exception. This is and what without getting too much into the weeds, they take these very large medical imaging files and they allow doctors just to stream them and look at them on their phone while they're on the golf course. And in 2024, you look at that and go, oh, that wasn't a thing. Actually, it wasn't a thing. Not that long ago, it wasn't a thing. Now it's a thing. And these are the guys that do it. And the Mayo Clinic uses them, and every prestigious organization in the world uses it. And it's just like the whole medical imaging world is going this way. Right? And who do you go with? You go with the dominant player with the best software, with the best reference clients. Oh, and guess what? Turns out AI is a thing as well. And what does AI love? It eats images for lunch, right? Like, oh, we just happen to have a huge amount of medical images on file. So this is just a beautiful company, and they continue to execute, and they continue to have a very long runway. And I've got nothing good things to say about it except maybe the price, and that may or may not be a consequence of my regret.
So I'm not going to rub it in, but I was just doing a quick math here.
I've done the maths.
I'm sitting on about an 18 or 19 bagger, and I think a lot of our members would be too. But you would have been sitting on 173 times your money, which
would have been, yeah. When I sold out my last position,
you would have received half your initial cost base this year in dividends.
So here's a yes. You would have mentioned a Spiffy Pop to your audience before, right?
Define it, because we haven't brought it up in a while.
So Spiffy Pop comes from David Gardner, who's the founder of the Motley Fool. That's how we first met, actually, when we worked there. And a Spiffy Pop is when the share price increases in a single day by more than your cost base. So in my case, if ever there was a day where Pro Medicus was up by more than 85 cents, that was a Spiffy Pop. I actually had some multi-Spiffy Pops along the way. So it's just like it's a mind bender when you get those kinds of things. So,
well, you would have today because it went up $7.
So it went up almost 10x Spiffy Pop.
Yeah, in one day.
But I don't own them anymore. So anyway, but here's the other thing I want to mention is that I think as an investor, there's this wonderful thing called the rule of 5. Which is an old rule, but it's worth remembering. And it says it's a heuristic. It's not a hard law of the universe. But what it says is for every 5 shares that you buy, 3 more or less market average. Market's up, they'll be up by the same amount. Market's down, kind of okay. Not terrible investments, not great investments. Yeah, you'll get one that's an absolute dog. It'll drop 50, 60 more. And you'll have one that goes to the moon. And the interesting thing is that when you think, it's obvious when you think about it, something can, quote unquote, only go down 100%, but things can go up many, many, many times, right? And when you look at all the famous investors in the world, Buffett's the obvious one, but they're, the Peter Lynch's, the Howard Marks, the Fishers, whoever you want to point to, they're all the same. Look at Buffett recently. What's Berkshire? They bought a ton of Apple in, when was it, 2012? Like, that's kind of the story in the last decade or so of Berkshire. And he had all kinds of stuff that was rubbish within that. And it's very easy for other people to point and laugh or say, "Oh, you got lucky on that," and look at all the rest. Or when more realistic, when you're looking in the mirror and you're saying, "Oh, I've got a terrible strike rate, but I got lucky on these ones." And I would challenge you to actually don't see that as the anomaly. That's normal. That is absolutely normal. But for that to work, you can't be the kind of person who's going to lock in a profit every time it's up 10 or 20%.
Yeah.
Because you're weeding the flowers along the way. And you probably go, "I'm going to average down on the one that's down to make me feel better." But that doesn't work. The lesson here is, let your winners, well, a couple of lessons. Expect a bunch of losers. Expect a bunch of mediocrity. And every now and again, expect to hit it out of the park. But you should be very reluctant to sell a stock that is winning. And I don't mean the share price going up. I mean the business underneath it is going from strength to strength. Pro Medicus is a classic case in point. Yes, the valuation proposition looked worse and worse as it went up, but the business itself was getting better and better and better and better. Now, it's far better to own an incredible business that's a bit expensive than a crappy business that's on sale, I tend to think. And I'll shut up with my anecdote in a moment, but we mentioned David Gardner before. David Gardner has an insane long-term track record.
Yeah.
But 6-7 times out of 10, everything he touches turns to rubbish. I'm not speaking out of school here. He talks about this himself.
Yeah.
He's got an awful strike rate. Like, if he gives you a tip, odds are it's a bad tip. But his superpower has been he just hangs on to the winners. And so he bought Amazon back when it was nothing. He bought Google. He bought Apple when it was nothing. And he bought a ton of other stuff that went rubbish. And people go, "Oh, yeah, but he got lucky on that." And I'd push back on that. And so you'll only get 1 or 2 Pro Medicus opportunities in your career. It's all you need. It's all you need. Just don't be too fussy with the when a company is executing extraordinarily well with with deep moats and a long runway. Give it a lot of rope, because the regrets that the demons that come to haunt you at night are not, "Oh, I lost 20% on that stock." It's, "Why did I sell that? Because if I didn't sell that, I would now have 10 times as much money as I did." That's what's going to keep you awake at night.
The crazy thing is when you think about Pro Medicus, Sam and Clayton, so Sam being co-founder and CEO, he's just like one of the humblest, nicest people you'll come across. And Clayton is too. In fact, everyone that I've ever dealt with at Pro Medicus is much like that. Yeah. But for him to come out and say in the market release that they think they have 7% of the market is like just incredible. And then there's also a really salient point in there, which is that all of their recent installations of the Visage software has been cloud-based, and the competitors haven't shifted to cloud. And obviously, even the hospitals are migrating to the cloud because of electronic health records and a bunch of different stuff. Yeah. And that's just the US market too we're talking about, which is the best market. But anyway, fascinating business.
Can I just say that on terms of medtech, and anyone who's listening who's in the works in hospital or works in the health industry knows this. It's like the last holdout of fax machine and pages. Like, I'm not joking. Like, those things are used in the year 2024. And there's a very interesting, we've spoken about it with a number of CEOs in the space, and it's just, you're dealing with very large, slow-moving bureaucracies. There's a lot of investment that's been made there. It's very difficult to modernize without, because there's 12 different systems all speaking together and patched with 400 different sort of legacy updates and rah. So it's like, it feels late. Like, surely that's this horse is bolted. No, I totally believe that 7% penetration. I think there is a long way to run with what is available to them, given the level of technology adoption in healthcare.
Oh yeah, I agree.
We can talk about that all day.
I have a small holding in Pro Medicus, so I should disclose that. But I'm just going to keep riding this baby out.
Do it for your mental health.
Yeah, that's it. Yeah, it's just like, I'll see, because I if it's up $7 and what was it, 18 cents today at the time of recording this on Thursday, the 15th of August. I think my cost base is about $7.50. So,
wow, man. Well done.
Well, not nearly as well done as 85 cents. Jesus.
Go on, I'll give you another lesson. Another lesson there, right? I bet we're having a beer. It's the year 2014 or whatever it is. And I'm there going, well, I bought it at 85 cents. And you're going, oh my, I'm paying nearly 10 times as much as I'm too late.
Oh, yeah.
I'm too late. Now, we didn't have, this is fictionalized, but that's a very common feeling because we anchor on past prices. And I can't tell you the number of stocks I didn't buy, despite loving them, despite thinking the price was fair, because I looked at it and go, oh, I could have bought it there. Oh, I'll wait for it to drop 10%. And then I bought some stupid. And so I dip my hat to you. So it's nice of you to say, oh yeah, but it's not as good as your price. But to overcome that bias is very hard to do. And the lesson here is, you can't go back in time is the lesson. Unless you're Marty McFly, right? You can't go back in time. So all you can do is decide what to do right now. And is $7.50 a good price? Well, it turned out it was an outstanding price. Right?
Yeah, but you're right. Like that's one of the things that David Gardner always does talk about is he's the this is his counterpoint. He searches for companies that have had strong past price appreciation, which has always perplexed literally everyone in finance. He looks for stocks that have gone up a lot.
Yep.
Because everyone else is searching 52-week lows, which is a minefield. He's looking at which stocks have gone up the most. So, and which ones is traditional media calling expensive. That's kind of like one of his biggest signals to buy a company, which is crazy to think, but it works. And good on him.
And the other part of that is too is just averaging up.
Yes.
Averaging down is not always, I mean, it is if genuinely nothing has changed and the value has improved. It's a great thing to do. But more often than not, we do it just to make our losses don't feel as bad. It's a psychological protection mechanism. Averaging up is very hard to do. I bought some at 85 cents. Well, I'm not buying it now. It's at $3. Why would I do that? But all the best investors do. If the thesis is playing out, and in fact, this will mess with a lot of people's brains, is that share price can go up, but the value can improve. It might be better value at $2 than it was at $1. And the reason for that is that at $1, the risks were far more obvious. The reward not obvious at all. At $2, the price is twice as much, but a lot of those risks may have been overcome. Maybe it was early stage. Maybe you didn't know the new product was going to get traction. Maybe you didn't know the expansion into Europe was going to work. And so you pay a higher price, but you do so at a much better risk reward proposition. So don't anchor on prices, I guess what I'm saying, and don't be afraid to average up.
Like Afterpay, when it expanded into the US, a lot of people said it couldn't work. And so the share price was kind of mulling around. And then as soon as they got some traction in the US, the thing shot up. And sure, you might have regret about that, but that was the uncertainty that everything hinged on. Top of the league tables, we've got Commonwealth Bank of Australia, came out with its result. Net interest margin dropped. We can explain what that means in a sec. Actually, I'll just explain it now. Net interest margin, or NIMS, NIM for short, is basically the difference between what a bank can lend its money out and earn a fee versus what it costs to get that money. So if it gets a deposit or if it goes to, say, the US debt market and needs to get money in to then lend it out, what's the difference? It's like the banking profit margin. That was 1.99%, which was down 0.08. I know we're talking about little numbers here, but that's really important when you've got hundreds of billions of dollars. Operating income flat, 27 billion. Operating expenses up 3% to 12 billion. Loan impairment expense dropped 28%, but there looks like there is some interesting things building. I'm just reading an article here. CBA reported as troublesome and impaired assets increased to 8.7 billion in FY23, up from 7.1 billion. So sorry, 8.7 billion in FY24, up from 7.1. So an extra billion and a half plus some change. So, the CEO's come out and said, Matt Common's come out and said, many Australians continue to be challenged by cost of living and et cetera, et cetera, et cetera. Goes on to say in the outlook that the economy remains resilient, well positioned, but downside risks continue. Which,
by the way, I can say that at any point in time. Classic management. There's good, there are things to be positive about, but on the other hand, as
I was reading this, I was like, who put this together? But
A PR person put this together. Yeah.
But you can, I might be the one person in Australia that feels for the complexity of a bank CEO like this, because it's like when they communicate a message, they've got to somehow keep all the retirees that need the franking credits and the ETF investors that rely on the franking credits. Yeah. And they need to kind of keep them happy and say, yeah, we paid a really good dividend this year. Shh, don't talk to us about it too much. But on the other side, they have to be, oh, yeah, people are struggling. We don't want to charge too much in interest.
Yeah. Don't regulate us too much. One thing I noticed is reading it, particularly this year's results, is like how political it is. Not overtly, but it's just like, I felt like I was reading them with a veil lifted, and it's just like there is all kinds of signaling going on here. And there is a very clear message, which is, make sure that you lower rates because we're all doing it tough and it's super important. And you kind of need us to stimulate the economy, and people are doing it tough. But look, we're really nice. We're helping them. And it just, there is, I mean, and I guess they have to be because they are such an important player, but it's sort of never, Munger says, never, ever, ever think about anything else when you should be thinking about incentives. And I think Matt Common understands that pretty well. Although I don't often tweet, but I did tweet this out, which was I had to laugh. In the announcement, Matt said, the CEO, we will play our part in stimulating economic growth by lending to productive parts of the economy. At which point I just like spat my coffee all over the screen, because 70% of their lending is for home loans. And say what you like about housing, it ain't a productive, it ain't a productive investment. And I know that's going to trigger people, but it's just not, right? You don't make it's shelter. It doesn't make anything. 17% of the loan book is for business. So it is hilarious that you can, with a straight face, say that look at us, we're helping to stimulate the productive parts of the economy, when patently you're not. Anyway.
What you're saying is invest with NAB. Okay, got you.
I just here's the other thing. What's changed? And again, this is I guess there's a dripping with opinion and bias here from my perspective. But go, verify this for yourself. Go back 20 years. Go back 30 years. Those proportions were very, very different. Banks obviously have always provided home loans. They've done that since day one. But even if you go back, I looked it up. When you went back to 2004, we had 59% of the loan book was for home loans, and something 26% was for business. And so it's just been shifted over the years. When if you say, what is the role of the major banks in the Australian economy? It's like, it's lending finance for residential property. That's what it is. Oh, but they do a little bit of, they do a little bit of it, but no, most of what they do is that. And again, I'm not trying to put a value judgment on it, but let's stop pretending that it's anything else other than that.
Yeah, no, that's fair. CBA. So that's we can call it there. It's everyone else is going to.
No, I'm not done, mate. I've got some more to say.
Take away, go on.
Okay, so first of all, and I'm sorry, I did mention this on the Motley Fool pod the other day, so I'm sorry if I'm repeating it for anyone, but banks, we often talk about PE ratios for stocks. Everyone will be familiar with that. When it comes to banks, a more popular, more traditional measure is the price to book ratio. A balance sheet is everything. I mean, it's always everything, but for a bank, it's everything, right? It's like everything. And book value is just net equity. They take all the assets, and their assets are our mortgages, and their liabilities are our deposits. So it's sort of backwards for a bank. And anyway, their shares are currently on 3.1 times book value. Now, is that cheap or is that expensive? Well, the long-term average for banks in our market, any developed liberal Western democracy, is usually around 1.2, 1.5. So it's double. It's double what is historically is on average. Like, well, that's not necessarily bad, because maybe they're going to grow a heap, and that would justify it. It's like there's nothing wrong with paying a high multiple for Pro Medicus if it's going to continue to grow its bottom line by 30% per year type thing. But it's a highly mature business. Their dividends over the last 10 years, if you want to talk about that, has grown at an average compound rate of 1.5%. Inflation adjusted, their dividends have gone backwards. The purchasing power of their dividends have gone backwards significantly in 10 years. There is no growth. Okay, look at the forecast. So it's not my forecast. The big mega brains of the finance world, let's take the consensus view there and maybe take it with a grain of salt. But they're all calling flat earnings. And how can it grow? How can it? 1 in 3 Australians are banked by the Commonwealth Bank. They're by far the dominant player. Can they win more market share? Yeah, it's possible, but they're not going to double it. the local market, so I'm not having a go at them, but it's just like, it's an ex-growth business. It kind of has to be. They will tick along at system level growth. And some years they'll be 6-7%. Other years they'll be like this year, they'll be down 6%, but it'll probably average out at 3-4%. It kind of has, like the maths at a macro scale trickling out, kind of has to be that. So you're paying 3 times book, 23 times earnings, and you're getting a 5% yield, even if you factor up 3.5%, but let's factor in the franking credits for a pre-tax yield of 5%. Now I can get 5% risk-free in their term deposits. So, and there's no equity risk. I can get a convertible note on the bank, which give me just as good a yield, no downside risk. And so explain to me again, by the way, is the bank going to be around in 10 years? 100%. Is it going to be earning more than it is now? 100%. Is it a good quality business, well run? 100%. As far as a bank it is, it's absolutely brilliantly run. Who on God's green earth is paying this much for this bank? It makes no sense to me. Jamie Dimon, who's the CEO of JP Morgan, was recently quoted in an interview, I believe it was the Wall Street Journal, said, buying back stock as a financial company greatly in excess of 2 times tangible book value is a mistake. We ain't going to do it. So this is Jamie Dimon saying we're at 2 times and that's way too expensive for us. CBA's at 3 times. It's 100%. Let's not be too hubristic. It's very massively exposed to one asset class, i.e., Australian residential property. I'm not saying that's going to crash, not anytime soon. Maybe it will, maybe it won't. But here's the proposition for you. Things muddle along. They manage to go okay for a little while. With some dividends, some franking, a little bit of capital growth, I might 7, 8, 9% per annum compound over the next 5 years. Not terrible. It's pretty decent, actually. But if there is any kind of wobble here, and I'm not calling, I'm saying if, not when, if. And by the way, their dividends were cut aggressively back a few years ago, right, with COVID. They only last year, I believe, got back to where they were pre-COVID. So dividends can and will get cut from time to time.
For sure.
And so heads, I win 9% compound. Tails, I lose 30, 40, 50% of my capital. And I'll shut up. So I'll get off my high horse in a minute. But I have to make this point. The other thing is, with the way that the maths works, is that if their property loan book dropped by 10%, now this is not going to happen because of the structure and nature of it. But if for whatever reason they had to write 10% of their residential loan book off, so forget the commercial stuff, forget the business lending, consumer credit, just the home loans, they would be insolvent. And that's just the nature of banks. They're very cyclical entities, right? Like, again, watch The Big Short, right? Like, I don't know if you want the simple version of it. So I'm not saying that they are going to be insolvent, but I am saying it doesn't take much of a drop in the value of their loan book for their earnings to go massively backwards. They've gone 6% backwards in net profit terms this year in a market which is booming. House prices are up over the last 12 months and they lost money. And so investing for my money is more preparation than prediction in a lot of ways. And so I just really want to be clear, because people always misinterpret me here. I'm not calling for it to crash. And by the way, I said all of this a year ago and it's up 30%, right? So that is all you need to know. But if anything, the argument is strengthened, which is heads, I win a little bit. Tails, I lose a lot. This is a cyclical business exposed, highly leveraged to one particular asset. And just like, it strikes me as the most ridiculously asymmetric negative bet that you can possibly make. And it's a hard pass if that's not obvious by now.
I love that line, preparation, not prediction. Yeah. And it ties in well with the being generally correct. I mean, you're right. I think that the number one thing people need to remember is that purchasing power. If you buy from the CBA for income, if it can't keep up with inflation and you're taking the risk, then you need to it's pretty simple arithmetic from that point on. So just be careful out there, folks, is what I'd say. Speaking of being careful, Seek, and you shall find. Seek reported results this week. FY20 highlights. They've got improved placement share, delivered double-digit yield growth, which is a fancy way of saying, if I'm not mistaken, they increased prices.
Yes. Yes, that's exactly what it is.
Platform unification, total expenditure in line with prior period, sold Latin American assets. These are reading it verbatim. Reported NPAT due to recognized significant decline in reported NPAT due to previously announced Zhao Pin impairment a 9% reduction in valuation of Seek Growth Fund, which it says in brackets up 26% since creation.
Well,
with
credit
a one
where it's due. Yeah.
next to the creation of Seek Growth Fund was announced in 2021. Yeah. Anyway, so in other words, it was a pretty tough period for old Seek. Reported NPAT's fallen from 230 million to negative 59. On an adjusted basis, it still fell 31%. Sales revenue down 17%. So, I mean, there's a fair bit going on at old Seek. Interestingly, Ian Narev is the CEO, who's the former CEO of CBA.
CBA, true.
Yeah. Andrew, I don't know if you've got much to say about poor old Seek.
I do. I've got a lot to say.
Go on then. I'm not as familiar with it as I used to be. I remember selling it. I think I sold it at about, I'm just going to go back in the archives. It would have had to have been about $8 and it's now 21.
Well, so we mentioned before the best businesses to buy are those well positioned for a structural shift. Think about Xero, right? Everyone used to have desktop software for their accounting. No one does now. And anyone who does is an absolute pain in the backside for their account. Like it's just, it's 3 hardcore hangers-oners and the rest of us have moved to the cloud. Again, a lot of your audience may be too young, but back when I was a kid, ads used to be in the newspaper, right? So job ads, car ads, real estate ads. And they were colloquially known as the rivers of gold. That's why Rupert Murdoch is the richest man in the world. Well, used to be because of that, right? They're massive. And then guess what happened? The internet was invented and it all went online. Now, the nature of marketplace businesses is such that they tend to operate in winner takes all markets. So let's think about this. If you want to sell your car online, you're going to go where?
Car sales.
Okay. If you're not allowed to go to car sales, where are you going to go?
Car?
Yeah.
Facebook?
Exactly, right? Like you can't even think of number 2.
Yeah, I was trying to think. I don't know. Yeah.
There's others out there.
Put it on the screen.
Let's look at Seek, right? Where you need to hire someone. Where are you going to put your job ad? Seek, okay. You're not allowed to use Seek. Where are you going to go?
I know that there's
Indeed,
Monster. Yeah.
No.
LinkedIn, maybe. I don't know.
By the network effects are the most powerful thing in the world, right? Like it's so insanely. If you need to learn one thing about investing, it's find network effects. Here's a great example. Elon Musk took over Twitter and I would argue has completely run it into the ground. But guess what? And the Meta, owner of Facebook, owner of Instagram, super cashed up, super tech savvy, even they couldn't compete with Twitter. And still, they've got Threads. Who uses Threads? 6 people use Threads, right? Is Threads bad? No, it's perfectly adequate, except that there's no one on it. There's no one on it. And so Elon's there creating an absolute dumpster fire for X, and yet we all use it because, well, that's where everyone else is. It's the power of the network effect, right? There's a very long run up here, mate. I'll be a bit more concise. So anyway, it became very early on, Seek won that race and there's no one else. And they went from 40 million in revenue in their first year in 2001. They're now doing $1 billion in revenue. The trouble is they were doing $1 billion in revenue in 2017 as well. So they had this incredible cash gushing machine with a competitive advantage that was almost impossible to displace. Nothing is impossible, but as close to impossible to displace as you can imagine. They've got that. And so what did management do? And look, who am I to throw shade at these guys, right? But there is
You're the mighty Strawman.
Hubris can be dangerous, right? So, hey, we're masters of the universe. Let's go do it in Brazil. Let's go do it in China. Let's go, hey, there's 1 billion people in China. We're really good at operating, employment classifieds. Let's do it there. All they did was blow up money. And what are they doing? They're coming back with their tail between their legs. Nice little rule of thumb for anyone listening. Anytime a company that you're looking at or owning says, we're going to go make a move into China, run. Stop it. Whatever you're doing, sell and run a mile. Because I don't care what the charts say. I don't care how many people are there. I don't care about, what special secret sauce you can bring to the table. Run. because I can't think of a single example where that has worked out for an Australian company. The only exceptions are those that sell raw materials, but they're Australian based and we ship over the rocks. Other than that, like there is, even things like wine and lobster would do it, and vitamins, and infant formula. Even that didn't go well, right? So anyway, don't go to China. And they had a scenario where I would say in the pursuit of growth, they achieved, ironically, the exact opposite. Had they back in the mid-2010s thought, okay, we've gone from zero to dominating the market, we're tapped out. And they said, I tell you what, shareholders, we've got no more growth opportunities left domestically. We could go overseas. We can definitely do that. But it's very risky. More often than not, I don't know what the exact stat is, but more often, it must be 70, 80% of the time, it doesn't work. Domino's is another great example of this. Absolutely crushed the Australian. My Pizza Hut, ground them into the dirt. And then they went overseas and it was an absolute disaster. And then they're not dumb people, right? They really, the lesson is that you don't have the home field advantage and business is hard and you're facing incumbents that know the local market better than you and rah. But had SEEK said and recognized that, they would have said, actually, we're just going to run for cash. We're going to keep costs low, and we're going to earn a massive net margin, and we're going to pay 80% of that out as dividends. Shareholders would have made a fortune, but instead they blew up a bunch of money, chasing growth in foreign markets and starting a venture fund. And it's not the. It's like Jerry Harvey and his dairy farm. Like, what is an electronics brick and mortar retailer buying a dairy farm for? Like, are you kidding me? Like, it's got to. Am I in a simulation right now? And it's the venture fund has gone okay. I'm not gonna be too critical of it, but you don't buy SEEK. I'm going to either get into a private equity firm or I'm going to invest myself. I want you guys, because you own this beautiful asset domestically. So I think they've recognized that, and now they're stripping it back, and they're going to come back to the Australian business. And on that, I'm actually more interested now than I was before all this other stuff. Except, back to the price. It's despite the woeful share price in recent times, it's 7 times revenue. So it's a $7 billion company, and I use the price to sales because there aren't any earnings. They lost money in the most recent year. So maybe we could do a normalized thing or whatever. But they're very expensive for a business that is pulling back on all its admittedly failed growth initiatives. But it's like, well, where else is the growth going to come from? There'll always be a little bit of growth. You can be more efficient. You can launch new things domestically that might make sense or whatever. But I just can't wrap my head around 7 times revenue for a business that's pulling out of all of its growth initiatives. So it's another hard pass for me. Although the domestic business, beautiful, an absolute beautiful business.
Yeah, I think it's well said. It's a fascinating business, and I think the Bassett family behind SEEK have a kind of legacy in venture. So maybe there was something there, but that Xiao Pin thing was always a bit of a
gosh.
But
do it elsewhere, though. Do it elsewhere. Yeah. Like if you, I'm like, feel your druthers. If you want to do fun, do it, but don't do it within the SEEK business. That's a separate. You're muddying the water. My 2 cents, anyway.
Interestingly, like one of the things that I hear when companies have ambitious growth plans, like you laid out with them in 2017 or so, is that I think to myself, how did they fund it? And a lot of the times they use equity or debt. And I checked at shares outstanding, and they're neutral. So there's been no movement there. That's a good sign because it means equity investors, no dilution. No dilution. But if you look at the total debt, so since just using ticker terminal data here, June 2017, it was 240 million of net debt. It's now 1.16 billion. So they've got a significant hangover from all the stuff. So maybe they can sell some of those other things. I don't know. Who knows? But it's just, you can kind of end up with legacy problems that former management never really thought about. So we've got 2 more companies to get through, Andrew.
How long's the podcast, by the way, mate? Because I know I've crapped on quite a bit.
We're at an hour. So I reckon we can get through these next 2 in 10 minutes. And the reason
I'll give the short version.
Yeah. The first, both of these are like your bread and butter. And I think folks that are listening, can definitely jump into Strawman to hear more of your take, because both of these companies, you're the person that I think knows the most about both of these companies that I've come across, and you're the person who introduced both of them to me. So the first company, why don't we go with Catapult? I said it's ticker symbol CAT. I said maybe it's a dead cat bounce, Andrew. Just as
every chance,
because since the beginning of 23, it's risen from 76 cents and it's back up at $2.17. It hasn't been this high since, well, a long time, since 2017 actually. It did have a bit of a renaissance in 2021, but no signals from price. No signals from share price. But when it's significantly positive for a meaningful amount of time, I start to think, well, maybe they have righted the ship. Tell us a little bit about Catapult, mate. Like, where are you at?
So here's a story. I first bought it like 7 cents or something.
Oh, wow. Yep.
No, it's been a terrible investment. I mean, it's been okay. It's been okay because I've bought at much higher prices as well. I sold when I've made every mistake in the book with Catapult. So what you have here, for those that aren't familiar with it, if you like your sport, you'll almost certainly be aware of it, because these are the sort of little kind of like man-bra-y things that the athletes wear. It's got a little tracking device in the back. So it's kind of like, the way I describe it is a Fitbit on steroids. It'll measure 1,000 different data points. It's really good for coaches and trainers to sort of know what their athletes are doing. Well, let's call a spade a spade. They know what their assets are doing. These are very expensive assets. These are tier one athletes, right? And they're human beings. I'm not trying to dehumanize them, but they're assets, and they're very much they belong in as part of a business. And watch Moneyball, right? Speaking of The Big Short, watch Moneyball. It's a massive business. And so I just paid $100 million for this a linebacker. I want to get the most out of him, right? So if you're in elite sport, you've got one of these, and they're 5 times their nearest competitor in terms of penetration. So they dominate the market. They also have video solutions and the rest of it. Really cool tech. Came out of the Australian Institute of Sport a million years ago, and they just started. Again, it wasn't so much a structural shift, but an invention of an entirely new industry. It just wasn't something that was tracked before, and now we've got digital devices that allow us to do it. And so now we do it, and now it's a must-have. Management at the time got over their skis. They started believing their own brilliance. They were, look at us. Let's buy this. Oh, and let's buy that. And let's do this. And let's pay ourselves that. And let's expand here. And it was a disaster. So, and I stuck with it. Why did I stick with it? Well, maybe I'm looking back with rose-colored glasses, but underneath all the debacle, and it was a debacle with the former management team, the core business was growing at 20% CAGR per year. Revenue, sales, just going through the roof. Retention was massive. They just had no discipline around cost control. So they were growing in terms of sales, but diluting, and costs were growing much faster. So they were just never making any money. It's like, and what's the point of making $1 billion, whatever it is, in revenue if you're not making any money, right? Like, that's kind of the name of the game. We forgot that with a lot of the free money era that we went through, but that's kind of what business is for. And they didn't do that. And the market said, screw this. This is just a sinkhole for capital. They ended up bringing in a guy called Will Lopes, who ran Audible. He's pretty good pedigree. And he said, you know what, there's a really decent business here. And he was polite and he was smart enough not to throw the former management on the bus. But I think we can run this a lot better. So he cut a lot of costs. He got rid of a lot of ventures, and it was just like, we're going to focus on this, and we're going to focus on cash generation. And then COVID hit, right? Like 2 months after he did, COVID hit, and it's just sort of like, so it was all this. There was a lot of noise in here, but I think this is the lesson for me was in standing back and saying, are they solving a problem for their customers? Yeah, absolutely. How do they look on the competitive stage? Well, they're easily the market leader by a large margin. Is there growth? Yes. Do the people who buy it keep it? That's a really good sign as well, because maybe you've just got a really good sales team, but you've got a crappy product. Well, it's like, no, once you the churn is very, very, very low. So, okay, that's really good as well. And so he said, we're going to do this. And he's absolutely executed. So the market was and rightly so, right? Because management is always going to promise you, I know it's been bad, but things are going to get better. That is what management will say. And so for a long time, the market didn't believe him. But the numbers were there. And I kind of stupidly enough did. And well, not stupidly enough, it turns out it was good enough, and it's like you could have bought it at 70 cents not that long ago.
Yeah.
And I am not making the mistake of letting go of this one anytime soon. It's now the number one ranked stock on Strawman, incidentally.
Oh, is it?
Yeah, it's moved up the rankings. And I still think there's value to be had there. If I look into the future and I say, are there more is there more market penetration opportunity? Yeah, like there is a long way to run here, and they can further monetize their assets. They've got a huge amount of pricing power. With the exception of weird things like COVID, sport is an incredibly anti-cyclical business. Like we could be in a really crappy depression, and everyone's going to watch the footy, right?
Yeah.
It's kind of it's a really nice recession-proof. Recession-proof is too strong a word, but it's a very resilient business with very attractive economics. And without getting too much into it, they're at a stage now where I'm going to forget the number, but every incremental dollar of revenue, a very large part of that is dropping to the bottom line because they're kicking into the operating leverage phase where it's like, we've got the fixed costs enough to support our sales and added growth and continue with our R&D. But if we were to sell 3 times as many units next year, our costs are not growing 3 times as much, which is a really nice situation to be in. And now you're at a point where you can actually buy into a little bit of that narrative, because Will's been very extraordinarily consistent. Actually, if you go to Catapult's YouTube channel, we did an interview with Will last month, and he'll tell you all about. Well, it was a pretty good discussion, if I do say so myself. It was a pretty good discussion, and you'll learn a lot more. You'll learn a lot about the business and his vision for it. So yeah, I own some shares, so I'm completely biased. So take that all with a grain of salt. But yeah, things are looking good after a very uncertain period.
That's great. Yeah, well, I know you followed it for longer than anyone I know. And Will's involvement in the business always struck me as more sensible. And I just realized when you were talking there, he's now been with the company nearly 5 years.
Yeah.
Which seems like yesterday that he was appointed, but 2019 that he was got into the role. So it's good to see. And free cash flow basis, it's really starting to tick over.
Yep. There's one very quickly. There's a good lesson in this as well. Is that turnarounds rarely turn, is what Buffett often says, which is right. But when they do turn, I think we as investors, we're very impatient. Like we want now. I want share price go up now, please. But can you imagine if it was you put into that seat? And it's easy to be the armchair critic. Oh, I would cut costs. I would do this, and I would do that. It's like, yeah, and that could well be the right move. It was the right move actually in this particular instance. Nevertheless, those initiatives take years to bubble to the surface and to show results. So if you're seeing success today, it's because of very difficult decisions that were made years ago.
Yeah.
And so it's just be patient with a lot of these things, because I think we have very unreasonable expectations with how quickly things can and should turn around. It just takes time, particularly when you're dealing with a company in multiple geographies around the world, thousands of staff, and it's just hard, very hard to do.
X-ray Fluoroscopy Scientific, otherwise known as XRF Scientific Limited,
which is easier to say,
trades under the ticker symbol XRF, Andrew, is a company that you introduced me to many moons ago. It would have been 2019, I reckon, when you first started talking about it, maybe earlier on Strawman. Now, this business in particular, it has just monstered things for quite a while now, but in particular around about 2019, 2018. So since 2018, it's gone from 16 cents all the way up to $1.40. And this company is involved in making equipment that businesses can use for inspecting materials in laboratory environments. There are X-ray fluoroscopy machines that are like handheld, and you like put it into the dirt to see what kind of minerals are there. But this is much more scientific, hence the scientific name behind it. Tell us a little bit about this business, mate. I mean, it's still small cap. It's right in the crosshairs of the Strawman community, just under 200 mil market cap. Tell us a little bit about it, mate.
I do love, by the way, that everything's relative, right? And we all go, oh, it's only $200 million. Can you imagine if I met you at a barbecue and I said, I've got a business? Oh, really? Yeah. How big is your business? Oh, market cap of 200 million. You go, holy, my God, that is massive. But because it looks tiny next to CBA, we think, oh, it's a piddly little nothing. It's like, No, this is
Great business too. Profitable.
Great business. Like what?
Yeah, it's really good business.
Point out the problem here with this business, and frankly, it's great that it's too small for others to bother with. Because thank you, I will. It means that I'm competing against some rando on Hot Copper, right? I'm not 10 highly paid analysts in Martin Place. So I'll take that. Yeah. So basically, your listeners would have heard of the concept of the pick and shovel kind of investment, and it's Levi Jeans. Like, who made money in the gold rush in California? Levi Strauss did, because he sold jeans and everyone needed jeans. So when there's a gold rush, sell picks and shovels, right?
Yeah.
So the materials that they have testing equipment and they have consumable. Oh, here's another really nice business model, the razor and blade model. Anyone who's bought a printer knows exactly what I'm talking about, right? Printer, $100 for a printer. How can I go wrong, right? It's $80 for a cartridge. Are you kidding me? Like, it's just they're very nice business models when you get. No, I won't go down that path. Stay on track, Andrew. Stay on track. So that's their customers are predominantly mines, and in a mine, it is very important that you know the quality of the material that you're digging out. Like, there's certain grades that have to be adhered to, and like, am I digging in the right spot? And I'm going to embarrass myself very quickly for all the geologists out there who know far more than me, but it's super important. You cannot do without testing. And so they provide this really cool equipment and consumables. So once you've got the equipment, you need the consumables, right? And that's a really sweet thing as well. And you're very nice to give me credit, but I don't deserve it. I'll give a shout out to Luke Winchester. He's a small cap.
Winnie.
Yeah, Winnie. He's he runs Merriweather Capital up in Newcastle. You've got to get him on the show if you haven't. Like, Yeah, brilliant. He's a nice guy. I don't often have nice things to say about fund managers, but there are some exceptions, and Luke's one of them. And he was the one who posted it on Strawman, and his thesis was this: at the time, the financials didn't look that great, and he said, yes, but look under the hood. The reason that the margins and the cash flows aren't that good is not because the business is not that good. Well, there's a little bit of cyclicality in this kind of stuff. People buy these big capital equipments and then they don't need to replace it all the time. And especially when times are tough in the mining industry, you don't. But they had spent a lot of money on the XRF. Had spent a lot of money on CapEx, developing new machines, et cetera, et cetera. And so when the replacement cycle came, they had the best tech. They had made the investment. They had exhibited, which is very rare in the modern business world, of far-sightedness. They weren't preparing for the next quarter, the next half, the next reporting period. They're going, no, I don't know when something is. We're going to be positioned well for next time it happens. And to do that, and anyone who's run a business knows this, you have to spend money to make money. It is just, you don't just say open on the door and money just starts coming in. You've got to put inventory on the shelves. You've got to hire staff. You've got to pay the rent. Like, right? It's so obvious when you think about it. And they had made some very savvy investments. And so that when the CapEx cycle for their customers had turned, they were ready. They were ready to go. And all of the money and growth that they have seen in recent years, because they were flat for a long time before that, was a consequence of that. So the variant perception here, which is what you need as an investor, because if everyone recognizes that it's a great investment, it's too late. Like, we all know it's great. Everyone looked at it and went, oh, earnings are flat. Nah, pass. Mining's a bit down in the dumps at the moment. Pass. But if you're able to look a bit beyond that and say, yeah, I know that was then, but actually a lot of these earnings are depressed because when the cash flows are depressed, not because they're not doing that well, but because they're diverting a lot of their cash to future growth investment. And when you make sensible investments, you get rewarded in time. And that's the lesson of XRF. That's what Winnie saw. That's what piques my interest. And I've been an investor ever since. And and the other thing to note is that will turn again. At some point, the mining cycle will slow down and turn. We've already seen what's happened in iron ore recently. And mining is an incredibly cyclical game. So I'm sure it'll change, right? And then the market will overreact. I hope it does. I hope it does as a shareholder because they'll again throw their toys out of the cot, forgetting that, mixing my metaphors here, but baby will be thrown out with the bathwater. And anyone who can look beyond the next quarter will go, not a bad company, and now it's much cheaper. And maybe next year's results aren't that great, but they're going to be doing pretty well over time. So we've spoken to CEO a number of times. I've got to get him back actually on Strawman. Yeah, humble, smart. A good red flag for me is that the more hypey the CEO, the more I'm nervous. The more modest and conservative they are, the more I like them. Right? It's a good tell, because they're not trying just to pump the share price. They're trying to make sure that market has clear expectations. And when someone has been consistent in their messaging, as Vance is, I pay attention. So yeah, shout out to XRF. Great little company.
Yeah, great. It's a wonderful business. XRF Scientific. XRF is the ticker symbol. So we've covered a lot of ground today. We've covered how we share miseries about selling some of Pro Medicus.
All of it. Some of us.
I feel like I've sold all of it. We jumped into CBA and some of the language. Seek obviously made a few moves over the last few years, which may have led them astray, but maybe they can straighten things up a bit from here. Who knows?
Maybe.
Catapult, not a dead cat bounce in Andrew's opinion. It is starting to be cleaned up under Will Lopez. And finally, XRF Scientific. It is still the diamond in the rough. That's a cliche, but it is still there. And finally, of course, at the very top of the show, we talked about some commiserations and misery shared on becoming a mortgage holder, mate. It's a very privileged thing, but it can be painful. Two things that I want to leave people with. The first of which is that you had this great quote, which is preparation, not prediction. I love that. I love that. Like, just having a plan is so important. Yep. The second thing, and probably the most important thing for people that want to hear more from you, is to head to strawman.com. I'll put a link in the show notes. You can sign up between now and midnight Monday. If you happen to hear this and you're over bobsledding somewhere and you don't have an internet connection, and you do happen to listen to this on a Tuesday, just send me an email and I'll see if I can pull some favors. But at the end of the day, it's Monday night is the cutoff to join Strawman. What do you say, $990 or something?
Yeah.
Yeah. It's not that bad at all. And it's a great service to test out how good you are as an investor, but also contribute and hear from others and learn as you go. If you want to invest in small companies, this is the type of resource you absolutely need. Mate,
yeah, thanks, man.
So much fun. You're on Twitter. I'll put a link in the show notes so that people can get in touch any way you like. So I really appreciate your time and thanks for joining me.
Thanks, mate. Next time we're doing it, we're talking a bit of Bitcoin too.
Oh no, dangerous. Cheers, man.
Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.